Hello and welcome to today's video, where we'll be discussing how to start investing when you don't know anything about stocks. Investing can seem overwhelming and confusing, but it's an important step in building wealth and securing your financial future. In this video, we'll go over some actionable steps you can take to start investing, even if you have no prior knowledge of the stock market. Part 1. Educate yourself on the basics. The first step to investing in stocks is to educate yourself on the basics. You don't need to become an expert, but it's important to have a general understanding of the stock market and the different types of investments available. 1. Start by reading some introductory books or articles about investing. There are many great resources available that can help you learn the basics. Some popular books include The Intelligent Investor by Benjamin Graham and The Little Book of Common Sense Investing by John C. Bogle. 2. Another great way to learn about investing is to take an online course or attend a workshop. There are many online courses available that can teach you everything you need to know about investing, and many of them are free. 3. Don't be afraid to ask for help. If you have friends or family members who are experienced investors, ask them for advice and guidance. You can also hire a financial advisor to help you get started. 4. Understand the different types of investments. Stocks are just one type of investment. There are also bonds, mutual funds, and exchange-traded funds, ETFs. Each type of investment has its own benefits and drawbacks, so it's important to understand them all. Part 2. Determine your investment goals. Before investing in the stock market, it's important to identify what you want to achieve with your investments. Your investment goals will help you determine the types of investments that are right for you, as well as the amount of risk you're willing to take on. Step 1. Define your investment time frame. The first step in determining your investment goals is to define your investment time frame. Are you investing for the short term or the long term? If you're investing for the short term, you may want to consider more conservative investments, such as bonds or money market funds. If you're investing for the long term, you may want to consider more aggressive investments, such as stocks or mutual funds. Step 2. Determine your risk tolerance. The second step in determining your investment goals is to determine your risk tolerance. Risk tolerance refers to the amount of risk you're willing to take on when investing. If you're a conservative investor, you may want to stick with more stable investments, such as bonds or mutual funds. If you're a more aggressive investor, you may be comfortable with higher risk investments, such as individual stocks. Step 3. Define your financial goals. The third step in determining your investment goals is to define your financial goals. Do you want to build wealth over time, or do you have a specific financial goal in mind, such as saving for a down payment on a house or paying for your children's college education? Your financial goals will help you determine the amount of money you need to invest and the rate of return you need to achieve. Step 4. Choose the right investment strategy. The final step in determining your investment goals is to choose the right investment strategy. Based on your investment time frame, risk tolerance, and financial goals, you can decide on a specific investment strategy that's right for you. This may include investing in individual stocks, mutual funds, or exchange-traded funds, ETFs. Part 3. Choose your investing approach. Once you have a basic understanding of investing and have set your goals, it's time to decide on an investing approach that works for you. There are many ways to invest, including buying individual stocks, investing in mutual funds or exchange-traded funds, ETFs, using a robo-advisor, or working with a financial advisor. If you are just starting out, it may be best to begin with a simple approach such as investing in a low-cost index fund, which tracks a broad market index like the S&P 500. This can be a good way to get exposure to a diverse range of stocks without the risk of individual stock picking. If you have more experience or are interested in a more hands-on approach, you might consider buying individual stocks. It's important to do your research and choose companies with a solid financial track record, a strong management team, and good growth prospects. It's also important to diversify your portfolio by investing in companies across different industries. Investing in mutual funds or ETFs is another option that can provide exposure to a range of companies and industries. These funds are managed by professionals who make investment decisions on behalf of the fund's investors. When selecting a mutual fund or ETF, consider factors such as the fund's fees, past performance, and investment objectives. Using a robo-advisor is a newer approach to investing that involves using an algorithm to select and manage investments based on your goals and risk tolerance. This can be a good option for those who want a hands-off approach to investing, but still want professional guidance. Working with a financial advisor can also be a good option for those who want personalized investment advice and support. A financial advisor can help you create an investment plan based on your goals and risk tolerance, and can provide ongoing support and guidance as your financial situation evolves. Part 4. Open a brokerage account. Investing is easier than ever thanks to the rise of online investment platforms. These platforms allow you to easily buy and sell investments, track your portfolio, and access educational resources. Some popular investment platforms include Robinhood, E-Trade, and Fidelity. By using an online investment platform, you can take control of your investments and make informed decisions based on your investment goals. Part 5. Start investing. Once you have chosen your investing approach, it's time to start investing. One of the most important things to remember is to start small and invest regularly. You don't need a lot of money to start investing. Start with a small amount and gradually increase your investments as you become more comfortable with the process. This can help you build your portfolio over time and benefit from the power of compounding. You can also set up automatic investments, which will invest a certain amount of money into your chosen investments on a regular basis. When you are ready to start investing, it's important to choose a brokerage or investment platform that meets your needs. Consider factors such as fees, investment options, and user interface when choosing a platform. Part 6. Monitor and adjust your portfolio. Once you have started investing, it's important to monitor your portfolio regularly and make adjustments as needed. This may include rebalancing your portfolio to maintain your desired asset allocation, or selling investments that are no longer meeting your goals or expectations. It's also important to keep an eye on market trends and adjust your portfolio as needed. However, it's important to avoid making knee-jerk reactions to market volatility, as this can lead to emotional decisions and potential losses. Part 7. Stay disciplined and patient. Investing is a long-term game, and it's important to stay disciplined and patient. This means sticking to your investment plan and avoiding emotional decisions based on short-term market fluctuations. It's also important to maintain a diversified portfolio and avoid putting all your eggs in one basket. This can help you manage risk and maximize potential returns. And there you have it, folks. Those are some tips on how to start investing when you don't know anything about stocks. Remember, investing is a long-term game, and it's important to stay consistent and keep your emotions in check. If you have any questions or tips for new investors, feel free to leave a comment down below. Thanks for watching, and we'll see you in the next video.